Before you start trading or starting this whole journey as a trader, you must first understand the market psychology, also the mass psychology of the market. It's very important to design your systems and understand the mass psychology before you enter into the markets, before you start even this journey. So I'm going to look in this video at just a little bit of the mass psychology so that you can understand a little bit better and put it in the back of your mind always and never forget this. In the market there's mainly four types of animals: the bulls, the bears, the hogs and the sheep. Now the bulls are the people or the traders that makes money when the market is rising. They're not scared to take the opportunities, they take their trades, and they are just normal traders. The bears are the people that make money when the market is falling, and they're not scared of entering the trades because they're taking a position. The problem comes in with the next two, the hogs. Now the hogs get trampled upon. Really guys, they are the greedy ones. They are really greedy, and those are the people that mainly miss applying the four fears in their life. I'll not say applying them, but preventing them rather. The four fears in their life. They will chase the markets, they will try to pick the bottoms and the tops, and I can promise you on the end they get slaughtered. They are very greedy traders. And then the last ones are the sheep. The sheep in the market, they've got various roles in the market. Now they are just plain scared to do it. They would like to talk about the markets, they would like to predict the markets. They will tell you, yeah, I knew the market's going to go up, or I knew the market's going to fall. I knew this, and they would have very bold statements. But when you ask them, okay, so how much money did you make? No, I didn't enter the trade. They will overanalyze the markets. They will always look for a reason not to enter the market, but they will always talk big. They are very undecided when they have to execute trades. They will do this bold analysis. People love to analyze, they love to do technical analysis, but on the end they do nothing because they stay undecided regarding their portfolios and their trading accounts. With a mouth they've got big stories to tell, but taking the physical trade, that is a different story. Or they would just follow other people's, they will just follow them. Mainly they like to follow YouTubers or this newsletter or that market analyst. They will not do their own analysis if they follow other people, because then they can blame someone else if the trade goes bad. Yeah, I listened to ABC and he said that crypto is going to fall to zero, and that's why I believe that Bitcoin is going to go down, for argument's sake, or anything like that. They will never take the responsibility on themselves for their own portfolios, for their own trading. So please don't be a sheep and don't be a hog also, because you're going to get trampled upon. Rather be a bull or a bear, because those are the people that are really successful and make the money in the markets. Now, understanding price a little bit better, or the movement of price, is that each price tick represents actually only a momentary consensus of value between a buyer and a seller, and also the undecided traders, because they don't take a position, so they also sort of influence the market. The buyers and the sellers, it's that one single moment they agree on a price, and then there's a transaction in the market. That's just that one tick. That doesn't mean if that tick was up or down, that doesn't mean the market's going to continue in that direction. So after the tick that you just saw, that was consensus between a buyer and a seller. What would happen after that? Who knows? One never knows what the market's going to do. The fact that the market goes up 1 pip doesn't mean it's going to go up another pip. Or if it went up 5 pips, it doesn't guarantee it's going to go up another 5 pips. It's just that one moment, an agreement between two parties, a buyer and a seller, that valued the market at that price. That doesn't mean the rest of the market agrees with him. So that's why we must look at mass psychology rather, instead of just a single buyer and a single seller having a consensus of a price. That's why mass psychology is so important. You've seen in bear markets where the market can tick up for quite a bit just to fall again. So there were consensus between buyers and sellers, but those are small individuals or just an individual bank or so, but it still doesn't show us the mass psychology of the market. So be aware of not looking or listening to the mass psychology rather than looking at this little tick up. Okay, the market went up 2-3 pips and now you want to buy because the market's going to fly now. Doesn't work like that. So we're going to focus on the mass psychology. Now, crowd consensus in total, when you look at the bigger crowd consensus, they will also change from moment to moment. You know, one tick too much for the bears upwards will change their minds, for argument's sake. So you can see an uptick, a downtick doesn't say much for us. So don't get involved in watching the market tick by tick. Scalpers, yeah, that's what they do because they only after 1 or 2 or 3 pips. But do not sit there and constantly watching the tick chart, the live bar, and say, okay, it's ticking up, it's ticking down, it's ticking up. That's when people want to chase into the market, the fear of missing out. They think they're going to miss the next big thing because this market is now ticked up 2-3 pips very quickly. Now it's going to run. No, no, no. So market consensus can change. Individual agreement on a price doesn't make much of a change. It might make a pip change or a half a pip. Mass psychology can change at any moment. So it's very important to study the mass psychology of the market. Just remember, rallies end for a reason. Why? Yeah, it could be fundamental news. You know, I'm only about technicals, but it could be fundamental news. But you've seen a lot of the times when news just have a temporary effect on the price and then the mass psychology take over. In a bull market, negative news are actually a time for longer term traders or the masses to buy into because it's a little correction and that allows the market to look at the bigger trend. In a bear market, in a bear trend, a little bit of bullish news doesn't change the whole trend. We need numerous news events or fundamental events that will change the trend of the masses. They are slow to change. They don't change fast. But it can happen at any minute, and that's why we study the mass psychology. Now, rallies end when the bulls lose the enthusiasm, or when the market's dropping and you are short the market. That drop in the market will end when the bears lose the enthusiasm. And that you can read in candles, you can read that in momentum indicators. There's plenty of ways of reading that, and that we will cover during this course. For now, I just want you to understand that there's not always a logical reason why a rally ends. News isn't the alpha and the omega, the beginning and the end of everything. News, well, you will have the same news event and it will this year and next year or this month and next month, they will completely respond differently. That's because of the mass psychology, because of the mass or the bigger trend in the market. Remember, the traders study the mass psychology of the markets, and his goal is to discover the balance of power between the bulls and the bears, because that is what turns market. When the bulls rising but they're losing enthusiasm, and as the bears are taking over, they increase in enthusiasm, and that's what we call the balance of power. The power was in the hands of the bulls, and now it's shifting because they are losing interest, the enthusiasm. It's now shifting to the bears, and the power is shifted to the bears. So that's why we study the mass psychology, to understand what is the masses doing. If the masses wants to be long, we want to be long. When the masses want to be short, we want to be short. Now remember, price will rise as long as the bulls stay optimistic, and it will fall as long as the base stays optimistic. It's a very simplistic principle. I always get questions from people, but Johan, it has gone up so far, can it go higher? It must come down from here. It can't go up forever. Yes, it can. We're always in the big risk, or let's call it the recession of 2008. There was a lot of jokes coming out, and between us all, we joked about that. But there was one specific picture, and the two traders were standing there, and the one guy would ask them, "Can the market still go lower?" And the guy said, "Yeah." The only sure thing in the market is that I can promise you 100% guaranteed that there's excellent support at zero. That's the only guarantee you've got. But can the market go lower? Yes. Can the market go higher? Yes. Depends on the masses. If they are enthusiastic, well, it will keep going. It's all about the enthusiasm and how optimistic they are about the direction. The market is a huge mass of people trying to outwit each other. Basically, the winner takes all. As simple as that. It's a bunch of people that are trying to rob each other. That's what the market is all about. Yes, we've got the banks, we've got the whales, we've got all those big traders. But on the end, someone wants to take your money from you and you trying to take someone else's money from them. I always like to use the analogy saying I'm going to put 100 people in a room. Everybody must have 1,000 rand with them, and then I'm going to give all of them, well, each of them a knife. And on the end, the one that bleeds less gets all the money. Guys, that's just my personal, very violent picture of the markets, but that's what it is all about. The one that bleeds the least at the end of the day, of that 100 people, that will be the guy that got all the money. And that's what it's all about. It's very, very important to understand this. Everybody is out to get you. The banks are out to get you. Your broker is out to get you because you've got a couple of $1,000 or a couple of $100,000 or a couple of $100 in your account, and everybody wants it. You will have to fight for it. So the crowd in general may be stupid, okay? You might look at the news, you might do the analysis of the markets and look at the economy and listen to all these clever people that is way more clever than I am, and your summary of what they said might be the market must fall. And it makes 100% sense that the market must fall. But you sit there and the market keeps going up. Why? Why? Because the crowd might look stupid in your eyes. They might be completely stupid in your eyes because everything screams against the market. Although they're stupid, they are stronger than you. That's a reality you have to understand. That's why listening to conspiracy theories or a lot of YouTubers or a lot of analysts, you get these emails, these newsletters, they talk the talk. But do they really walk the talk? Do they really put their money behind what they say? So really, guys, be aware that the crowd may be stupid, but they are definitely stronger than you. And your opinion doesn't count. Crowds have the power to create trends. That's how trends are formed. Not because of one news event, not because of one bank, not because of one trader or a couple of this or that. The crowds, the masses will push the market from A to B or from B to C. Never argue with them. If the market doesn't want something, don't get in their way. Old broker said that to me once. Johan, if the market doesn't want something, don't get in their way because you're going to bleed. It's like catching a falling knife. You're going to get cut. You're going to get cut in pieces. The money that you make mostly belongs to a bank because they're taking the counter position. Remember now, in currencies or spread trading, mainly your broker takes the opposite position from you. So if you long, they short. So if you make money, they lose money. If you make $100, they lose $100. Now, you walk into a bank and try to reverse a couple of rands or a couple of dollars of bank fees. Yeah, that's not easy. Now, they don't have any intention of giving you that money easily. They're going to fight for it. They're going to try everything. So you're basically trading against banks every day, trying to outwit them, plus all the other traders. So you can see it's quite a fight out there. Now, how will you see and understand the mass psychology? Now remember, the chart that you see, that is the window to the mass psychology of the market. You can put indicators, moving averages, candles. You've got plenty of tools on there, and I will teach you a bunch of them to see what is the mass psychology. But remember, your only way to see the mass psychology is through the window of your charts. So your charts is everything. Yes, you can study news until you're blue in the face, but the charts will show you the reality. I read this once that they say that the technical analyst is an applied psychologist, often armed with a computer. That is so spot on. I can't remember where I read that. But the technical analyst is an applied psychologist, often armed with a computer. So use it on your computer and analyzing the psychology of the market. Because if you understand the math psychology, you know what to do. Individual behavior is complex, diverse, and difficult to predict. But group behavior is primitive and much easier to predict. I'm going to say that again. Individual behavior is complex, diverse, and difficult to predict. But group behavior is primitive, much easier to predict. So I like to use the following analogy. Is that let's put 100 people in a room and let's set that room alight. Fire goes up. Is it easy to say what the masses will do? If there's only one door, what will they do? They will most likely 90 to 95, if not 100%, will run for that door. As simple as that. So there's fire, there's a building, there's a door, they're going to run for that door. But there might be a few individuals that will respond differently. There might be a few individuals. Let's say you left your seat before the fire and you have 100,000 Rand worth of laptop lying under your seat. You would watch that fire and think, ooh, I must get that laptop. You would say, I think there's still time. So you're going to run against the crowd from the door to your seat to try to catch your laptop. Your child might be there. You might have something else of value there. You might even think you can stop the fire. You want to be the hero, for argument's sake. There might be one or two or three of those people. So if I put that 100 people in front of you and I ask you, how will each of them react when I set this room alight? You're not going to be able to tell me. If I point to certain people, you can't tell by looking at them, will you be the sucker running back into the building or will you follow the masses? It's very difficult. But if I ask you, what do you think this crowd of 100 people will do once I set this alight? You're going to say, they're going to run for the door. And you will be most likely correct. So that's why I said the individual behavior is complex, diverse, and difficult. Very difficult to understand. But the masses, it's primitive, it's straightforward, it's easy. So that you must never ever forget. Now, the last thing I want to cover here is that amateurs want to forecast price action. Professionals only manage their probabilities. Big traders, the big banks, the masses, they don't try to forecast. They never think where will the market go. All they do is they manage their probabilities, their risk. The probability of this trade working is 55.2%. When I'm going to be right, I'm going to have a 1 to 3 or 1 to 5 or 1 to 2.5, 1 to 10 risk reward. And they play the probabilities. That's it. They do not predict the markets. Amateurs always want to know, where do you think gold will go? Where do you think crypto? Where will Bitcoin go? Where do you think Ethereum will go? Where will oil turn? When will oil stop falling, for argument's sake? People will always want to do that. No, you've got a system to follow and you don't predict the markets because the masses don't predict the markets. They just go with the flow as the market moves. Your job is to analyze the mass sentiment and then bet on the dominant market group. That's simple. That is your job as a trader, as a technical analyst, even if you do fundamentals. Your job is to analyze the mass sentiment and then bet on the dominant market group.